Hi everyone, I'm Luke Staden from Staden Financial Management, and today I'm going to take you through some common investment styles you can use when managing your money or using an advisor such as myself. Now, when it comes to investment strategies and the different styles of investment strategies, there are probably infinite. There are thousands out there, but I picked 6 of what I suppose are the most commonly used ones, and we're going to go through value, quality, growth, dividend, momentum, and contrarian styles of investing. So let's start with value-based investing. Now, value-based investing is essentially when you are looking for companies which you believe are undervalued compared to their net asset worth. So companies which are fairly cheap, but have strong fundamentals. So a very promising balance sheet. And as a result, you're buying at a discount or a good price, and you're essentially waiting for the rest of the world to catch up to your way of thinking and go, oh no, hang on, this asset's actually worth more than we used to think it was. But because of that, it does require quite a lot of patience and a strong focus on fundamental analysis. So reading into companies' balance sheets and analysing from that perspective. When we look at the performance of value-based investing, we have to say that when it comes to bull markets, when the market's going really well and prices are just going up and up and up, value-based investing, although it will tend to do well because that's the nature of a bull market, it will tend to lag behind some of the more, I suppose, overpriced competitors. Because remember, we're looking for underpriced investments, but really, honestly, for some reason, overpriced investments tend to perform the best when everyone's throwing money at stuff. However, when we look at bear markets, so the opposite of a bull market, when everything's falling in price, well, in that case, value-based investment styles tend to be more resistant to negative market sentiment because they have a strong focus on fundamentals and good profits or good revenue income on each of the individual companies. That alone tends to shore off some of the more scared investors who are trying to sell their assets as fast as possible in a bear market, because they will basically look at the balance sheet and say, no, this is worth keeping on to. So value-based investing essentially is you're looking for underpriced investors, requires quite a lot of work in terms of analysis. And I suppose a great example of a value-based investor would be Warren Buffett of Berkshire Hathaway, who is probably the most famous value-based investor of all time. And if you look at his total returns against the S&P 500, he has managed to generate higher returns over the long term. So value-based investing can outperform the markets. You've just got to be quite good at it. Next, we have quality-based investing. Now, quality-based investing is a bit of a flip side to value-based investing. It's not a total opposite, but rather than looking for undervalued companies, you're just looking for really well-run companies which tend to have low debt, tend to have high return on capital employed, so high revenue generation from investment. And because of this, and all of those kind of factors are quite highly priced when it comes to valuing an asset, it's often that people look at quality-based investments and say, well, hey, you're actually paying more than you should. You're buying assets which are too highly priced. So that's kind of the opposite of the value-based bit. And the fundamental kind of approach here, or the reasoning, is yes, it's more expensive than perhaps I'd like, but because it's got good management structure, it's well run, it's got low debt, I think that this is a good long-term based investing. And essentially, you're just trying to find companies which have been doing very well for a long time. Typically, you want companies which have been around for decades, if not centuries, and are expected to continue doing well in the future. And because of this, most quality-based investment styles are looking for companies or assets which are immune to technological disruption, or at least resistant to it. Now, technological disruption is when you have a new piece of technology come around which basically makes what you were producing previously obsolete. So a great example of technological disruption is we used to have cassettes, we used to have VHS players, and then DVDs and CDs came out. And it kind of made all of them obsolete, and all of the companies producing them and only them lost a lot of value to make way for all of the companies producing DVDs and CDs. Then streaming came out, MP3s, and it kind of made all of those obsolete. Now, an example of a company which is fairly immune to technological disruption, weirdly, you might not expect this, is Nintendo. Now, Nintendo, their technology, if we compare them to their competitors, which would be the Xbox and PlayStation, I say this as someone who plays video games occasionally in my spare time, it's worse. You know, it's not as, the performance isn't as good, and yet they still have a loyal fan base. And the reason they have a very loyal fan base, and the reason people always kind of queue up to buy Nintendo products, is because they've got very strong IP, intellectual property. And because of this, they're fairly immune to technology disruption. You know, Xbox and PlayStation could release consoles which triple the power of them, do really, really well, perfect for gaming, everyone loves them. But they can't play Zelda or Mario, so people are always going to come back to Nintendo. When we look at quality-based investments, they tend to perform fairly well during periods of bull markets, or the market going up. They would probably outperform value, but they would lag behind growth. When it comes to bear markets, quality-based investments also tend to do fairly well, because remember, we're looking for companies with low debt and a well-run and high returns on capital employed. So they tend to be a good overall performer and aren't necessarily as swingy as in price as assets in the growth-based category, which we're about to come on to. Now, what is a growth-based investment strategy? Well, a growth-based investment strategy is essentially when you're trying to find something which is going to grow as much as possible, normally in a short period of time, but also in the future. And because of this, you're looking for companies which don't really make much money yet, or sometimes make no money, but have a huge potential to make loads of money in the future. And one of the most common kind of areas that growth investing is centered on is high-risk tech. So a great example of a growth-based investment was at the start, Amazon. Amazon didn't make money for years and years and years and years, but people kept on investing in it because they saw the potential that Amazon could take over and make billions and billions and billions in revenue every year. And those investors were proved right, because Amazon now has a load of revenue and is valued very high. So essentially, you're looking for companies which could become the next Amazon while they're very small. And because of this, loads of risk ties into this, lots of volatility. These assets tend to swing up and down faster than anything else. And because of this, they do so in bull markets. These are the best performing assets you can have. When everything's going well, they shoot up and up and up, and it's really, really, really exciting. But then in bear markets, when everything's falling again, they drop like a stone, and it's really, really scary. They are the roller coaster investment strategy, in my opinion. Goes up loads during times of market sentiment being quite high, falls crazily during market sentiment being quite low. On the next one, we have dividend-based investing. Now, dividend-based investing is, again, kind of the opposite of growth-based investing, because when you're looking for dividend-based investments, you're looking for companies which have grown pretty much as they're going to grow, aren't looking to reinvest their profits into their companies, but are looking to distribute them to the shareholders, so distribute them to the owners. So the reasons why you might have a dividend-based strategy is if you're looking to generate constant income from the portfolio. Unfortunately, dividend-based investments are never guaranteed to pay you a dividend, but you're looking for companies which have got long-term profits and a history of distributing that to the shareholders. The dividend strategy the stock prices doesn't really grow that much during the bull markets, because every time companies are generating value by generating profits, those profits just go straight out and into your wallet, because they're redistributing it to you in dividends. And conversely, when we have bear markets, well, these companies that offer dividends tend to be companies which have a fairly economically resistant client base. So a great example of a dividend-based company is a utility company. So let's say an energy company which distributes energy around the country. Now, typically, most of these aren't going to grow by much because they've already got most of their audience captured. And even when we have time for recession, the markets start falling, people are still going to need to heat their homes, keep their lights on. So the profits are going to still keep coming in. And because of this, dividend strategies tend to be fairly neutral, not entirely neutral, they are still affected, but much more neutral to market sentiment compared to the likes of, well, for instance, what we just covered, growth-based, which are incredibly affected by market sentiment. Now, next we have momentum-based investing. Now, I don't like including momentum-based investing because honestly, I don't really respect momentum-based investing, because momentum-based investing is really just following trends. You're looking for, essentially, if you had to sum it up in a few words, it is you buy performing assets, you sell underperforming assets, which seems like a good idea. But really, you're just looking for assets which a load of people have just bought and the price has gone up. And when you're looking to sell, you're looking for assets which people have already sold a load of assets, and then you sell it as well. Now, my problem with momentum-based investing is because it's kind of brain dead. You are not doing any analysis yourself. You're not trying to work out what you want your portfolio to look like. You're just looking around the room and seeing what anyone else is doing and say, hey, I'm going to follow that. That guy's selling, I'm selling too. Oh, that guy's buying, I'm going to buy too. And it always guarantees that whenever you purchase an asset, you're never buying at the best price, and you're never selling at the best price, because the person who just did that, who you're copying, has already got a better price than you. And it kind of basically is FOMO as a strategy, fear of missing out. Now, it does do pretty well in times of bull markets, right? Because when everyone's buying and prices just go up and up and up with an asset, if you see someone buy an asset and you copy them, well, trends tend to continue as long as market sentiment never changes. And as well, in times of bear markets, if you're selling an asset after someone's sold, it's probably likely that other people are going to sell that, especially if they're all doing momentum-based strategies. The problem comes when you have a shift from one market sentiment to the next, or a shift of market sentiment on a particular asset to the next. Because if people are buying and then you buy at the highest price, and then it shifts, you are watching the value come down. And then if everyone else starts selling, well, then you sell again. And essentially you're buying high, selling low. And the other thing to note about momentum-based investing is you have to do so many trades, because it's a very active strategy. It's constantly keeping on top of the market and just following trends and hoping those trends continue. And then when those trends don't continue, then you get out. And the truth is, you as a human, you're never going to be able to do it better than an algorithm. And the best momentum-based investors are algorithms, computers, which kind of have all of this programmed into them already. So I don't respect it as an investment strategy, full stop. But even if they did, it's hard to recommend any individual doing it. Now, the opposite of a momentum-based strategy, funnily enough, is one I actually really like, and that's contrarian-based investing. The reason I like contrarian-based investing isn't necessarily because it's the best investment, it's because when it works, you feel fantastic. And contrarian-based investing is basically you look at what the market's doing and you do the opposite. If everyone is buying assets and everyone's really happy and the bull market's kind of going up and up and up and up, at that point you start selling assets, or the higher risk assets, which are very swingy, and start buying lower risk assets or hedge your bets. So you could be investing in loads of tech funds. Everyone loves the tech funds. They go really, really high. You sell them, you buy gold. And the problem with contrarian-based investing is that during a bull market, it does badly, okay? During a bear market, it does badly because you're doing the opposite of what everyone else is doing. And if the trend continues, you do badly. But where it really shines is when you have a transition from a bull market to a bear market, or a bear market to a bull market. And the reason I love it as an investment style is because when that happens, you feel like you mind gamed the entire market. And you feel very good about that investment because it's you making money because you did something that no one else did. But which is the best, right? I suppose that's the question. Which of these is going to be the best style that you should use in your investment strategy? And my answer is going to be quite annoying. None of them. Well, actually, all of them. Well, all of them perhaps, except maybe momentum. And what I mean by this is that when you're constructing a portfolio, it's never a good idea to bet everything on one style of investing. Because if you bet everything on growth and then we have a bear market right after, all of your assets are going to sink like a stone in value. Maybe you've lost half, maybe you lost 75% of your assets overnight. Even the highest risk investor is going to feel that. Conversely, let's say you go value-based. Well, then if we have a bull market for the next 8 years, which can happen, well, your assets probably do okay, but you're going to be looking at what could have been when it comes to the more higher risk swinging assets. So whenever I say it comes to portfolio construction, I say don't just choose one, choose a mix. Okay, I like to have growth-based investments. I love having quality-based investments in every portfolio. I just think it's a solid investment style. You're buying well-run companies. What can you really argue with that? Have a mixture of value, dividend, and contrarian. Well, contrarian maybe not. Contrarian-based investing it tends to be when it comes to purchasing. I have a contrarian style of investment when it comes to when I buy these, but not when it actually comes to buying assets. Anyway, nevertheless, let's say we take these top four. If we have a portfolio which has all of these four different styles of investment in it. When it comes to changes in market sentiment, let's say we have growth-based strategy. Well, when bull markets are doing really, really well, this is when the contrarian bit comes in. We sell some of these growth-based investments, and then we put them into maybe the value-based investments or the dividend-based investments. Or we put them into, for example, a gold miners fund for a hedge. When assets are doing well, we kind of de-risk them a bit, take some of our profits and move them to more underperforming assets. Because we know that investment sentiment and investments have a cyclic return on growth. We know that investments don't just go up in a straight line, they go up like this. And if we have asynchronous strategies, so strategies which aren't following each other's patterns, then when one does well, we can take investments from that and move it to the underperforming strategies, which then when the trend reverses and these strategies start performing really, really well and our growth-based investments, for example, start falling like a stone, well, at that point, we've got strategies which aren't falling like a stone, strategies we can then take profits from or sell in order to buy these really discounted growth strategies, which we know that we have quite a lot of faith in long term. We just know short term they're not doing so well, so we have an opportunity to pick them up at discount. So that's my answer. You don't pick one, you pick many. And you use their asynchronous returns in order to maximize your long-term growth. I'm Luke Staden. Thanks for watching and have a lovely day.